Welcome to GRE. I'm your host, Keith Weinhold. Home prices have fallen in 6 U.S. cities. The average age of a first-time homebuyer soars to an astounding 38 years old. Then we take the long view, breaking down how real estate is up a jaw-dropping 490% since 1984, the Trump effect on real estate, then how you can earn an 8 to 10% cash-on-cash return hassle-free, all today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from St. Louis, Missouri to San Luis Obispo, California, and across 188 nations worldwide, even Uzbekistan. I'm Keith Weinhold, and you are inside Get Rich Education. Every week, it's the show where I pretend that I'm not wearing pajama pants while here on the microphone. Hey, if you want to get rich, then focus on one thing. If you're already there and want to stay rich, then that's the point in which you want to diversify, because then you're already living your daydream and you don't want to lose it. We'll talk about President-elect Trump later in this week's show and what it means for the future of the real estate market.
Thank you very much. So this outfit, is when he called us all garbage. How stupid. What a stupid word. That blows deplorable away, don't you think?
Well, our content will surely be more substantive than that funny piece. I expect to host Donald Trump here on the show for you in the future. After all, let's not forget, before politics, he was most known as a real estate investor, but he's going to be busy for the next 4 years, so it could be a while until you see him here. Before we get to the Trump effect, last week, the NAR released their annual report. It's called The Profile of Buyers and Sellers. My gosh, what a surprise when it revealed that the average age of a first-time homebuyer rose to an astounding 38 years old. 38! I mean, we're not talking about a person that's like severely underemployed or something. We're talking about the average here. So for many, they are still a renter into their 40s. That is common now. At this rate, pretty soon, are Americans going to become homeowners once they hit retirement? My gosh, is that where we're headed? Or when one looks at their rites of passage, the milestones in their lives, will one achieve grandparenthood before buying a first home? Where are we going here? Not only is 38 years old the all-time high, as you might have expected, but that is up from age 35 just last year. Amazing. And like I've discussed before, of course, the major reason that age is up is due to lower affordability, and that's from higher prices and higher interest rates. The housing shortage is another factor here too. And all right, if that's not enough, the average age of U.S. home buyers, okay, this is just overall home buyers, first-timers and everyone else, that was 49 last year, and it spiked up to 56 this year. 56! And now, back to first-time homebuyers, the average income has also hit an all-time high, $97,000. That is the average income of a first-time homebuyer now. So what's important to keep in mind here is people are going to have to rent longer. They're already renting longer, and some will choose to rent longer as a preference, and for others, they must rent longer. You can be the one to provide them with this rental housing, not the big hedge funds doing it, not private equity doing it. Invest in real estate. These trends mean higher occupancy rates and upward pressure on the rent amounts that you're going to be able to charge over time. I mean, this is demand, demand, demand for rental housing. They wish that they could buy that $300,000 starter home in the Midwest and Southeast, but they have a hard time affording the down payments and qualifying for the loan thereafter. So you can rent it to them and be a profiteer longer. However, right now there are 6 U.S. cities where home prices are falling. And now these are pretty mild corrections, but let's see if you can guess what the top reason for this is, the number one reason about why these prices are falling. Among the nation's 50 largest metros, these are the 6 cities that have seen price corrections. New Orleans leads the way, down the most, down 4%. Austin, Texas is also down almost 4%. San Antonio down 2.7%. Tampa, Florida down 0.5%. Jacksonville down 0.3%. And then finally, Dallas, Texas also down 0.3%. And in fact, I am visiting 3 of those 6 cities during a 10-day stretch that I'm on right here, right now. Over the weekend, I was in San Antonio, Texas. Today, the mobile GRE studio is in effect again, as I'm bringing you today's show from here in Austin, Texas, where I'm spending 4 days, and then I'll be in New Orleans in 2 days here. Well, the top reason for these falling home prices is, in a word, supply. In fact, it's an oversupply in a lot of these 6 cities. And again, those 6 are New Orleans, Austin, San Antonio, Tampa, Jacksonville, and Dallas. In fact, here in Austin, they are basically a national leader in oversupply. They simply overbuilt, and it's going to take some time to absorb all that they've built. In fact, due to overbuilding, you've even got rents falling here in Austin, and I may look at some vacant apartments while I'm here to get the temperature of the market. Now, for some context, understand, though, that I spotlighted 6 falling markets out of the 50. All right, well, what about the other ones? Yes, that indeed means that 44 of America's 50 largest metros have seen year-over-year price increases. And one big reason for that is that many metros have housing shortages. Shortages are the norm. And by the way, all these figures are per the Zillow Home Index. In fact, a number of markets are up over 4%, 5%, 6% year over year. And the leaders all have 7 to 8% year-over-year home price appreciation. They are San Jose, Hartford, New York City, and Providence. And a lot of the appreciation leaders are, undersupplied, the opposite of what I'm seeing here in Austin. Now, before I get to the headline of this week's episode, how national home prices are up a breathtaking 490% over the last 40 years, let's talk about the Trump effect. It's still 2 months before Donald John Trump will be sworn in as the 47th president of the United States. And like macroeconomist Richard Duncan and I touched on last week's show, Trump loves tariffs. Everyone knows that. And a tariff is like a tax on imported goods. Now follow along here. Higher tariffs mean then higher consumer prices because the company or manufacturer has to pass that cost along to you. Higher prices means inflation. Higher inflation means that the Fed tends to keep interest rates higher longer in order to combat that inflation. So a Trump presidency means higher inflation and interest rates again? Yes, at least those two things are correlated. And now think this through. Do you sense some cognitive dissonance here? Under Trump's first term, back from 2017 to 2021, he wanted lower interest rates. And Trump was highly vocal about how he wanted Jerome Powell to keep rates low in order to keep the economy healthy. So the higher rates that Trump tariffs are expected to bring then versus the lower rates that Trump wants is dissonant, incongruent, not in harmony. Bitcoin surged on the news of a second Trump presidency because Trump is pro-crypto. Now, see, Treasury yields, they also spiked upon the Trump presidency news. Just 2 weeks ago, I explained here on the show why higher inflation means higher Treasury yields, which means higher mortgage rates, and it turned out that that was quite a timely explanation. The Trump election can mean a lower tax environment. We are hopeful that Trump will extend bonus depreciation, a really nice tax break for real estate investors. We could see some federal lands repurposed for housing construction. Trump said that he wanted to do that in order to add more housing supply. And no, don't worry. I don't think they're going to shut down and pave over Yellowstone and plug Old Faithful Geyser or anything like that. Okay. There's a lot of federal land that's, I guess, less remarkable, land that's being grazed on, and land suitable for more housing. Look for more move to loosen up zoning and regulation, and that's something where you'll find bipartisan agreement. We've got to build to address the housing crisis. I mean, Trump has actually called zoning a killer, like he used that phrase. You might see Trump extend the Opportunity Zone program as well. The result could be more apartment construction in some of these blighted or low-income urban areas. No matter what, and no matter who our president would have been, I mean, you're still going to see housing supplies struggle to keep up with demand because you just can't build fast enough. And you know something here? You never really know the future. People always want to speculate about the future. That can be worth talking about, and, you know, that makes people think that they have the answer, but they're often wrong about one thing leading to the other, like how tariffs will end up meaning higher mortgage rates. I mean, you just don't know that for sure. Policies can change, promises might not get followed up on, black swans can interject, and interest rates are one thing that are just wildly difficult to predict. And if you ever want to make another person look wrong, like if you desire to do that, here's all you need to do. Ask them where interest rates are going to go in the future and make them put that in writing. Okay, that is a guaranteed way to make somebody wrong. So everyone wants to know the future, but you've got to think through this in terms of probabilities and not certainties. Now, here's something encouraging. California voters, they shot down rent control expansion. Though you might live in California, we are not exactly passionate about investing in California property for pretty well-documented reasons. But sometimes things that start in New York and California, in those particular states, they can expand to the nation. So it's worth paying attention to some of these things. And California voters resoundingly rejected what is known as Proposition 33 rent control expansion. Almost 62% voted no on that. So you've got bipartisan alignment on how rent control backfires on renters. And this was the third time in 6 years that California voters shot down rent control expansion. Great. That is great because rent control, it's not good for you, the investor. Long term, it's not even good for the tenant, and it's certainly not good for the community either. I mean, they are collectivist state price controls. Well, let's look at another place where prices are not being controlled for sure, and that is the fact that overall U.S. home prices have appreciated a whopping 490% since 1984. Yes, 490% over the last 40 years, therefore almost a 5x price increase. Let's break this down, and then I'll tell you what it means for the future, too. This is the shift in U.S. home prices from August 1984 to August 2024. So therefore, it starts from mid-Reagan presidency, when the median home price was $81,000 at that time. Okay, so this is our starting point, 1984. That's the year Ghostbusters hit movie theaters. Kareem Abdul-Jabbar broke the all-time NBA scoring record, and shows that debuted on television that year were Miami Vice, Night Court, Punky Brewster, Charles in Charge. Have you heard of these shows? Another TV show that debuted in 1984. Oh, jeez. Are you ready for this? Let me give you a hint. Temple University, and how about Jell-O Pudding Pops? Yes, I'm talking about The Cosby Show, which just feels kind of different to talk about anymore ever since Bill Cosby's illicit misconduct there. And no, we are not going to play a snippet of the Cosby Show theme music. Please don't play it. You know we totally do something like that here, but we're not this time. Okay. Well, with home prices surging an astounding 490% since that year, 1984, okay, let's break down the areas that have appreciated the most and least and see what that means. And you might remember that in our newsletter, I sent you this map that shows the level of each individual state's 40-year price surge. Oh, this is great. It's just the best real estate map I've seen in a while. What it shows is that coastal states are where home prices have risen the most in general. The top 10 in appreciation in order are Washington State up 810%. Yes, that's more than 8x in the last 40 years. The next highest home appreciation over the last 4 decades in order is Oregon, Rhode Island, California, and then it's Hawaii, Montana, Massachusetts, Maine, Idaho, and 10th is Utah. All right, well, why have coastal states had this higher real estate run-up over time? Well, it's where building constraints exist. That limits the housing supply. That's both geographic constraints, like, for example, the ocean's edge literally limits build space there. Well, the coasts are also where you tend to have more building regulation. Coasts are where incomes have risen the most. Those residents can afford more for housing, so home prices are then higher. I mean, just look at the leader, Washington State. That's where you've got the headquarters for Amazon, Microsoft, Costco, Boeing, Starbucks, Expedia, and more. They're all there. Now, taxes, though, they do tend to be highest in coastal states as well. So you're paying more for property, and you're also paying more in all types of taxes in a lot of cases. And as we know, rental properties usually don't work as well on the coasts. Coastal rents haven't risen as much as home prices. And these places, they tend to have those laws and regulations that often favor tenants over landlords. And if you're looking at the map here like I am, you're going to note that some Rocky Mountain states have flexed their appreciation muscles as well. Now, Tennessee and the Texas Triangle, they kind of decided to join the appreciation party fashionably late as you look over 40 years. Yes, Tennessee and Texas, they really only started their big appreciation climb about a decade ago. All right, so those are some of the big winners every year since Punky Brewster debuted on television. Well, with today's rise of remote work and lower home affordability, the nation's interior, that's what looks increasingly desirable for property ownership. The Midwest, the Great Plains, parts of the South, and parts of the inland Northeast. That makes these areas look like comparative deals where prices haven't wildly run up over the decades. And though you hear about return to office policies because a few major companies announced these return to office policies, I mean, remote work is still up fully 15% year over year, and housing preferences are shifting as employees look to suburban metro outskirts for more affordable homes. So they're freed from the need to factor in these lengthy commutes in their lives like they had to previously. Now, among states that don't have strong in-migration, one that could really shine is a place like Ohio. Ohio's appreciated less than most states, still at 334% over the past 4 decades. Again, 490% is the national number. Ohio boasts tons of diverse industry, a low cost of living. They've got the 7th highest population in the nation. They have a stable population count For rental property owners, it has strong laws favoring landlords, and Ohio is just a day's drive from half of North America's population. All right, so a smart listener like you is probably asking yourself a question right now, like, okay, how does this 40-year stretch's 490% rise in national home prices compare to inflation? And how does it compare to incomes? Over this time, there's been 201% overall inflation, and U.S. median household incomes have risen 260%. And yeah, that 201% inflation number is suspect, just like most any inflation figure is. Inflation could certainly be higher than that because most inflation measures likely understate the true diminished purchasing power of your dollar. And see, the 490% rise, although it sounds like a staggering number, and it still kind of is, it's also like, well, of course it takes almost 5 times as many dollars to buy a home today because each dollar's value is way down. What else has changed in the last 40 years? Well, houses are larger now than they were then. The median home size has grown 150% since 1980. And at the same time, the family size is smaller. Fewer people live in each home, so everyone has more space. And I discussed those types of things in detail with you before, so I won't get into all of that again. Today's homes have better amenities too. So really the point is, if you are paying more on an inflation-adjusted basis, you are getting more. And it's also more likely that 2 parents are working today rather than 1 in order to make those payments more affordable. And that fact right there, that is not a great lifestyle outcome. Another way to say it is that it takes 2 to afford a home today rather than 1, but yet, hey, that is society. All right, so with that understanding, let's look at the future. I completely believe that real estate values can soar another 490% over the next 40 years. I mean, even 600 or 700% is not out of the question, and there are a lot of reasons for this. I mean, chiefly, we're starting from a base here of a low housing supply, and we've got strong demographic demand, and we can almost certainly expect more monetary inflation in the next 4 decades. The inflation rate is the one thing that nobody knows. 40 years ago, mortgage rates were 14%. Today, they're only at about half of that level. And see, today's median home price of over $400K, like that figure would have seemed unfathomable to people back in 1984, but indeed, the price nearly 5x'd. So similarly, another 490%, or about 5x again, means that it is completely fathomable for the median U.S. home to cost $2 million in another 40 years. That's about 5x of today's prices. And although that might sound unrealistic now, that sounds just as unrealistic as today's price did to anyone from 1984. So really a super interesting way to think about home price appreciation there. You might even make the case that home values, not prices, home values, they're not up that much at all. I mean, most of that is just that prices have adjusted for inflation. The value is about the same, although I'd still say that the value is up somewhat. So really, that's my thought there. And I duly regret bringing Bill Cosby into this whole thing. I ruined it. I've been coming to you here from Austin, Texas, where I've been checking out the real estate market. I've got more for you straight ahead. It is a really profitable idea. I'm Keith Weinhold. There will only ever be one episode 528 of the GRE podcast, and you're listening to it. Oh, geez. The national average bank account pays less than 1% on your savings, so your bank is getting rich off of you. You've got to earn way more, or else you're losing your hard-earned cash to inflation. Let the liquidity fund help you put your money to work with minimum risk. Your cash generates up to a 10% return and compounds year in and year out instead of earning less than 1% in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And you know how I know? Because I'm an investor in this myself. Earn 10% like me and GRE listeners are. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866. Hey, you can get your mortgage loans at the same place where I get mine, at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Rich Dad, Poor Dad author Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to GRE. We are grateful to have on the show today the co-founder and CEO of the whole operation, Freedom Family Investments. They are 7, soon to be 8, I just learned, real estate-centric companies based in Centerville, Ohio. The other co-founder is her husband, Flip, whom you've heard on the show before. Hey, it's terrific to have back Dani Lynn Robison.
Thank you so much, Keith. I love talking to you.
It's the same here. You've been in real estate since 2008, and one of the things that you do is you have this perfect track record of always returning capital to your individual private investors, loans that they make to you, and paying 100% of the returns as promised, even if you yourselves end up losing money on a particular deal. And in fact, you, the listener, you probably heard me talk about how I personally participate for a high yield return with them myself, with Dani Lynn's company backing me. You've heard that ad near the middle of GRE episodes, and you yourself can do this too. Individual investors can get a high yielding return, and it's paid to you as cash. So Dani Lynn, tell us about how it works generally.
I love that you started off with that particular statement, because I will tell you that every time I've been on a podcast of yours, the number one thing I hear when people get on the phone was, you said on that podcast that even if you lose money, that I still get my return. And I have never heard of that before, so tell me more. So that's a perfect lead in, because I think that what we're trying to do is just do a very good job of serving the people who help us build. So as you said, we're on company number 7. We're building company number 8. And the reason that we've gotten to the stage that we are today is because we've had private lenders and people who invest in our syndication, our master notes, and our funds program. That investment has allowed us to buy properties, flip properties, buy apartments, apartments, and allowed them to get a return at the same time. And I've talked about the fact that we do volume. As we've grown, we'll do 10 deals in a given month, and maybe 1 or 2 of them are we find something, in the wall that we didn't expect. Maybe we walk in and the past tenant left it in shambles and caused more damage to the property than we anticipated when we first went in. That's the nature of real estate, and that's the risk you take when you're an active real estate investor. So we knew when we were building our businesses that if we just did volume, that was going to happen, and we weren't going to run away from that fact or take risk upon us or our investors by not mitigating it, by not doing volume. So you'll see situations where somebody does 1 flip a month and that happens to them and it's catastrophic. When you're doing 10 and it happens, which it will, then you know that the other 8 are going to bring the profit in. And so that it is easy for us to say, thank you, Keith, for investing in us. This particular deal, we didn't lose any money on, but these 8, we made a lot of money on. And that ensures that we can always pay you back in full on time, even if we lost money on a deal. And I think when that is explained to people on the phone, they start understanding why we can pay back everything as promised, even if we lose money, because we are still profitable as a company. And so that process of doing volume and having people trust us with their funds as we've grown has allowed us to get to company number 8, because as we talked about right before we press record, one of the best things for us, Flip says, I love being Santa Claus. And Santa Claus is when you get that email or that check in the bank account that says, I just made money and I didn't have to do anything. I just partnered with Flip, Dani, and the Freedom team to do what they do already. I provided the money. They did the work. We all won together.
Why does no real estate rehabber ever find gold bars behind a wall when they go in order to turn over a property, right? It's usually, evidence of a leak or something bad, usually not something good going on back there. But yes, you do this volume across all these companies. So therefore, when you do find a leak behind a wall and that particular deal didn't work out for a 100K rehabbed home, it sure can't bring down the entire operation. Dani Lynn, I've invested with you in your private money lending program for years now, and I've just been very open with my audience. I've let them know that I've been receiving an 8% return from you, paid in cash. But one reason I'm having you back now to help our audience is because you now offer yields up to 10%, so even better than when I got in. So tell us about that.
So we are always having conversations with our investors about what's going on in their investing journey. What are they looking for? And we want to create those win-wins. And right now, with everything that's going on in the market, what we've learned is liquidity is one of the most important pieces, because there's some fear, there's some uncertainty, and people want to invest. They don't want their money sitting idle and having an eroding to inflation. They want to put it to work, but they want to have access to it. And so we have been changing and tweaking our programs to meet the needs of our investors and making sure that we are buying properties that can then have that arbitrage to get us the profit we need to pay back our investors, but we're still making a profit. Many times right now in this market, that does mean we're buying multifamily properties because there's so many different advantages to multifamily properties. It does take a lot of underwriting to get there, but that's where for the last, I would say 6 to 12 months, we've been really focused in on that in order to increase the returns and have everybody just creating that win-win.
I'm really glad that you talked about multifamily properties, because I've talked with the audience about how the sector is beaten down. In a lot of places, you can get 30% discounts on multifamily apartment buildings, and we know that the long-term demand is going to be there for occupancy in apartment buildings. Demographics is destiny. And we're talking about this timing of having you on, and now you're offering up to 8%. Discussing this, say, 2.5 years ago, I don't think the timing was as good. That's when CPI inflation peaked at 9.1%. So you really weren't getting a real yield. You need to subtract inflation from your yield in order to get a real return. And now you're getting a substantial real return since inflation is near 2%. Top online savings accounts, those top interest rates, they are falling with each successive federal funds rate cut, and most expect that those yields are going to continue to fall. People invest in bonds all the time, but the yield on the 10-year T-note has been around 4% for quite a while. You don't have to settle for yields like that. And Dani Lynn, I love that you brought up the word arbitrage. This should be an arbitrage play for you, the listener. But of course, for Dani Lynn, it needs to be an arbitrage play as well, because if she and her family of companies over there are paying you a yield of up to 10%, they need to make arbitrage on top of that themselves. And if you're a new listener, you might be skeptical of how you could reliably do that in real estate. But when you understand that real estate pays up to 5 ways at the same time, and 30 to 40% total rate of returns without inordinate risk are not dreamland, the reality, you can begin to understand the arbitrage. But Dani Lynn, can you tell us a bit more about how you do create that arbitrage to reliably pay a return of up to 10%? How do you yourselves beat that in there?
That's where it comes down to multifamily for us. The single family market has slowed down a little bit, and so multifamily is enabling us to do bigger things, but on a long-term basis. We've built our companies up enough to a point where our businesses are producing the cash flow that we need. So we can pay our investors a higher return using the cash flow of the properties. And our long-term wealth as a company is coming from down the line of the appreciation, especially in multifamily, the forced appreciation and that refinance and that windfall. So everything that we structure is preferred returns, meaning we always pay our investors first and we come last. When it comes to multifamily, those 5 ways start to compound over time. And that's where we really win, is because we know we're waiting, but we're waiting for a big return in 3, 5, 7 years. Sometimes we're waiting 10, 20 years. And our investors in the meantime are getting a really nice return, better than they can in most other places, because we're willing to forfeit our current returns in this scenario because our other businesses are producing the cash flow that we need.
That's terrific. Tell us a bit about the program details then. How is this note, right? Because the investor, as soon as they make an investment with you, they do hold on to a note. Just tell us about how that's secured before we get into the details.
So it depends on the investment opportunity. Some investments are going to be secured by a note by the property. Some investments are going to be secured by a note by the business. Some investments are going to be secured by the fund itself. You're an actual owner, or the syndication. You're an actual owner of what that fund is participating in. So every piece of security is a little bit different. So when you jump on the phone with us, we're asking a lot of questions. And the number one question that we ask is, what are your goals? Because if you do want liquidity, we know exactly where you're going to go. And some people are wanting liquidity for peace of mind so that they can earn a higher return, but have access to the cash if they want it. Some investors are saying, hey, I know there's about to be a lot of opportunity, so I want my money earning for me, but I want to be able to grab it to be able to invest in these future opportunities that are going to come my way. And I want access to the capital for that reason. Then there's other investors that are set it and forget it. Look, I like you guys. I trust you guys. I've vetted you guys. I've done my due diligence on you guys. I want to sit my money in there for 3, 5 years. Some want tax benefits. And so what we do is we have this table of investments with little check boxes. And as people tell us their goals, we're like, okay, there. By the end of the conversation, we're saying, here's the 2 investment opportunities we think fits what you like and what is going to meet your needs. What do you think? And then we start going with question and answers back and forth so they can fully understand it.
We're talking about how to get a high yield paid to you regularly in cash with Dani Lynn Robison, co-founder of Freedom Family Investments. Yeah, Dani Lynn, why don't you tell us then about this up to 10% return, but you do have some option based on people's needs for the duration of the investment, which gets into the liquidity and the minimum investment amount and being accredited versus not accredited. So tell us about some of those distinctions, differences, and trade-offs.
There's the accredited and non-accredited piece, which is really the first piece that you should be talking about when you jump on the phone, because the answer to that question depends on where, we first check the box of which investment opportunity is going to be right for you. Accredited investors can invest in both. Non-accredited investors can only invest in non-accredited options. So accredited, I'm sure you've explained many times on the podcast, is $1 million net worth minus your primary residence, or earning $200,000 for the last 2 years and you expect to earn it again. Or if you're a married couple, earning $300,000 a year for the last 2 years and you expect to do it again. That would be an accredited investor. And so if you qualify there, we've got multiple opportunities. Then if you're wanting liquidity, then again, that's a checkbox for us that says liquidity fund. That's where you want to be learning more about. You want to learn about those interest rates. The liquidity fund is 7, 8, and 10%. Based on how long you want to put your money to work. So some people say, hey, 1 year is good. That gives me exactly the liquidity I need, and that's going to give me a higher rate of return, which is 8%. Some people think 3 years is liquid. It's interesting to me what people perceive as liquid, because anybody who's invested in a syndication knows sometimes that's 5, 7, and 10 years. So they view a 3-year investment at 10%. Hey, that's liquid to me. I didn't have to lock it up for 5, 7, and 10 years. And then some people, 90 days is liquid. And so we have the liquidity fund, 7, 8, and 10%, depending on which class you want to go in. 7% is 90 days, 8% is 1 year, 10% is 3 years. That's for accredited investors. We have our master note program, which is for non-accredited investors. That is 8% for 2 years and 10%, I think, for 3 years. And then we have Lincoln Village. And That one is closing soon. I think we're at the final $1 million to raise. That is 12, 13, and 14%. But that also includes tax benefits, and it is a 5 or probably 7-year timeline because it's a 48-unit apartment in Columbus, Ohio. If we refinance in 3 years, yay, everybody wins. But I always set expectations. It could be a longer timeline. And so those are the main opportunities that are available based on accredited, non-accredited, and your returns.
Well, the yield on the 10-year T-note is 4%, but here the yield on the 1-year private note is substantially higher. Well, Dani Lynn, do you have any last things to tell us before you let us know how we can learn more?
I think what's important is the trust. When I'm on the phone, I get 3 questions. Where do I start? Which path is right for me? And who do I trust? And one of my biggest investors says, Dani, I think number 3 question of who do I trust is the most important one.
Yeah.
So I think it's really important to get on the phone, to ask questions, to ask, hey, what didn't I ask that I should have asked? What should I know that I don't know? Because sometimes you don't know the right questions to ask. And so we have this graph of all the things you could be looking for in an investment that people don't even realize might be very important to them. So I think what is most important is just taking the first step of starting the conversation. Once you start the conversation, you start to learn, you start to get educated, you start to understand what your true goals really are, and then you can make a confident decision, as opposed to what many of us do is, sit on our hands for a little bit because we're just nervous. We're so nervous about losing money, or we don't know who to trust, and we're so busy that a year passes by and we just didn't take action. So I just encourage people, a 15-minute phone call might change the game for you and allow you to get started.
Right. Indecision really is a decision in itself, a decision to not do anything and have some of your cash be atrophied to inflation. Tell the audience how they can learn more.
We can text the word family to 66866. And that is going to connect you with our team. And we're going to reach out, hopefully set up a call and get that conversation started.
Oh, Dani Lynn, this is going to help a lot of people. Thanks so much for coming back onto the show.
Thank you, Keith.
Yeah, well, I think you know that I'm more of a borrower than I am a lender, but I'm a lender in this case. So for liquid funds, this has been a reliable source for an 8% liquid return without any hassle. I mean, it's about as passive as it gets. Of course, when you store money in a bank, you're giving the bank a loan as well, even though you might not have thought about it that way. Well, if you're looking for something a little less liquid, like a 3-year investment duration, you are going to get a higher return than 8% here. There are good options here if you're accredited or not accredited, and you don't have to invest in one specific apartment project either, like Lincoln Village that Dani Lynn mentioned. And over there at her company, like she said, yeah, those are the 3 questions you can ask. Where do I start? Which path is right for me? And who do I trust? And on the phone, really part of that second question, which path is right for me, can be to ask Dani Lynn's team about how to get this highly passive return in the most tax-efficient way for you. There's so much vital content coming up here on the show in the future. Next week, it's the first time we'll have a former NFL player on the show as we'll discuss success principles that you can use in business and life. Highly motivational stuff coming there. In future weeks, so much more economics and real estate investing content is coming, including I've got an analysis of online search results, and you'll see what amenities tenants are really searching for today when they look for rental housing. And of course, as the year gets closer to the end, next month, I am going to reveal GRE's home price growth forecast for 2025. And just as importantly, I will follow up with last year's prediction too. We'll look back at it and then see how it really turned out. For high yield returns on your savings, you don't have to settle for disappointing interest rates where you spin your wheels because you're barely beating inflation. Learn more, set up a call, just text FAMILY to 66866. I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.